Brendan Mckenna, international economist and FX strategist at Wells Fargo Securities. Thank you for coming.
Thank you for having me. Much appreciated.
I want to start by talking, Brendan, about the current state of the stock market. Do you think the recovery rally that started at the end of 2022 can continue? We are seeing so much strength in the markets right now, at least in equities.
I do think that equities can continue to rally, and I think that's based on a very broad assumption that the banking stresses that we saw in the United States and Europe remain contained. I think that can restore some confidence that the Federal Reserve and many other regulatory and other institutions around the United States and Europe can kind of contain all of these stresses, and that should, again, improve sentiment, improve confidence, and that's something that can drive equity markets higher in the coming months and quarters.
And talking about rates, because you said equities, maybe in the fixed income, is not the same vision, but I would like to talk about interest rates, because today Barkin and Collins from the Federal Reserve were saying that maybe a last hike of 25 basis points was needed. Do you think the Federal Reserve can keep raising interest rates?
I do think they can keep raising interest rates, and I think a lot of that goes back to the theory that the banking stresses are contained. Now that you have those challenges that are somewhat less challenging than they were a couple of weeks ago, I think that makes the Fed a little bit more focused on inflation and can bringing inflation back down towards target ranges. So in that sense, I do think that the Fed has at least one more 25 basis point rate hike in them. With that said, it does look like the banking sectors probably bring forward or at least make a recession a little bit more likely. So you might get higher interest rates in the very short term, but by the end of this year, it wouldn't be overly surprising if the Fed starts cutting interest rates and you see 2-year and 10-year bond yields start to trend lower across the United States, again, by the end of this year, maybe early 2024 as well.
That is very important because we are seeing the yield curve steepening again. So is this going to affect the investments, do you think?
I think a yield curve steepening is actually a relatively good thing. Anytime you can get away from a yield curve that's inverted, that's generally a positive indicator that sentiment and confidence is starting to improve. So all in, I think, if it's going to affect investments, I think it's going to affect investments in a more positive way, especially if the Federal Reserve is shifting the stance of monetary policy in a more accommodative direction.
I would also love to talk about GDP numbers that came out today. It was revised for the fourth quarter of 2022 from 2.7 to 2.6%, and PCE keeps at 3.7, while the core figure increases to 4.4%. Do you think the next quarters are going to show less growth than 2022?
I think Q1 will probably show less growth than what we saw in Q4. But with that said, we're actually expecting a decent amount of momentum to carry forward into this year. So you'll still see a positive number for Q1. You'll probably still see a positive number even in Q2 of this year. I think a lot of that comes back to households still having a lot of cash on their balance sheet and consumption trends overall remaining relatively resilient. So we do have a view that the U.S. economy will fall into recession, but that recession may not occur until the second half of this year. So for Q1, we're looking for a positive number, relatively robust economic activity. Q2, same type of dynamics, maybe a little bit of a slowdown from Q1, and then we start to see the impact of the Federal Reserve rate hikes and the banking sector issues kind of culminate and result in some negative GDP prints over the second half of this year.
And Brendan, if the second half of 2023 can have a recession, even if it's a low one, how the investors can or should position? More defense or more aggressive during this cycle?
Yeah, I think that's a really great question. And it's kind of this tug of war between economic conditions deteriorating, but at the same time, as I mentioned, the Federal Reserve is going to be cutting interest rates and shifting in a more accommodative direction. And anytime you get lower interest rates and a Federal Reserve that's trying to orchestrate this soft landing and will generally try to support sentiment as much as they can in that type of environment, that's usually a risk-on environment for equities. So there's this old saying that the economy is not the financial markets, and there's dynamics that impact each in different ways. And I think this probably is a really good example of if the Fed is going to cut interest rates, that's probably something that can generate more positive sentiment towards equity. So I think in the second half of this year, even if we're in a recession, that's generally going to be an environment that's positive for risk assets and equities, not only in the United States, but around the world.
And finally, I would love to ask you about the US dollar. Is it going to fall during the next months if the rates are coming again down, do you think? Is the carry trade affecting these movements?
Yeah, I think the outlook for the US dollar is a little nuanced in the sense that in the very short term, and maybe the short term out towards the end of Q2, I think the dollar is probably just going to tread water and trade sideways. You have a Fed that's probably going to raise interest rates, but at the same time, they may not be the most hawkish central bank in the world anymore. The ECB is probably on top of that throne right now. But over the second half of the year into 2024, as the Fed does start to signal interest rate cuts, as the economy does tilt into recession, those are all dynamics that can eventually place depreciation pressure on the US dollar and lead to a lot of these foreign currencies actually strengthening going forward. So we do have the view that the US dollar is not quite on the brink of this prolonged period of depreciation, but we're getting very close to it. And over the next couple of quarters or so into 2024, we'll start to see those depreciation pressures mount.
So we'll keep an eye on that. Thank you, Brendan Mckenna, international economist and FX strategist at Wells Fargo Securities. Thank you for your time.
Thank you for having me.